This is my thesis right now. I believe they are going to intentionally destroy the dollar. They're going to destroy the dollar to support the system. I think what they're doing with the stablecoin legislation is they are trying to move the majority of debt issuance to the short end of the curve through stablecoin issue. They're going to destroy the dollar. They're going to inflate the crap out of it. They're going to use the stablecoin legislation to front load debt issuance into the front end of the market. And then they will let gold go to the heavens. I believe this. Truly, I do. And they will peg it to the long end of the bond market to have zero borrowing costs to reshore manufacturing, to sell treasury debt bonds at a much longer duration at a zero borrowing costs redeemable in gold. I think they're going to do this.
As the global financial system groans under the weight of unsustainable debt and deteriorating trust in fiat currencies, Andy Schectman presents a stark warning. The US dollar is being deliberately positioned for destruction. His thesis revolves around a coordinated plan to inflate the currency aggressively while redirecting the architecture of the debt market via stablecoin legislation. This is not monetary mismanagement by accident. It is a systemic pivot designed to re-engineer how the United States issues and services its debt. The goal, Schectman argues, is to crowd the front end of the yield curve using dollar-backed stablecoins to absorb demand in a treasury market. The implications are enormous. Stablecoins would allow for synthetic demand creation, covering for the lack of organic buyers like China, Japan, and other former primary holders of U.S. treasuries. With debt issuance front-loaded at short maturities, policymakers can inflate the dollar, as they must, while gold is allowed to rise unchecked. Eventually, Schectman believes, the government will peg gold to the long end of the bond curve, anchoring 30, 40, and even 50-year treasuries. This will enable ultra-low borrowing costs needed to finance a massive domestic industrial revival, effectively reshaping the foundation of U.S. monetary and fiscal policy. This, Schectman argues, is how the system survives. The dollar collapses, inflation runs rampant, and gold is repositioned as the backbone of sovereign finance. From the perspective of asset allocation, this represents a powerful signal for institutional investors and high-net-worth individuals. If the dollar's purchasing power is set to implode by design, and gold is to be structurally revalued upward, then capital flows will continue exiting traditional assets, stocks, bonds, cash, in favor of tangible, unencumbered wealth preservation vehicles like gold and silver. This is not speculation on market cycles. It is a directional change in the way monetary policy is conceived. The transition will not be smooth or transparent. It will involve volatility, market distortions, and public confusion. But behind it lies a strategic objective: to maintain control over debt, restore manufacturing competitiveness. This thesis, while controversial, is finding increasing validation in the behavior of central banks, sovereign entities, and informed capital across the globe. Before laying out the full logic of this thesis, Schectman begins with recent developments in the precious metals space. Developments that make clear the price of silver in particular is far from reflecting its true scarcity and strategic value. If you're finding value in this analysis, don't forget to subscribe, like, and share. Let's dive into the details with Andy Schectman.
I've been thinking a lot about the gold to silver ratio. And, you got Goldman Sachs and JP Morgan forecasting $4,000 gold by next year. I think that's pretty reasonable, actually, on many levels. But assuming that plays out and the gold to silver ratio were to get to 50 to 1, where it's averaged about 45 to 1 for the last 150 years. At 50 to 1, which is very conservative, at a $4,000 gold ratio, that puts silver at $80 an ounce. I mean, you're talking a double, easy double. And so when I think about where silver could ultimately go, there are so many things that are screaming silver and its value right now. UBS just raised its target to $42 an ounce. That's about an 11% increase. But when you look at all of the things that have been happening, to me, whether it be the increase in the lease rate, the lack of shares available to short or to buy to cover shorts on SLV, the massive delay from T+1 settlement in London to T+8 weeks in London, the huge deliveries. When you look at the distortions that we find in the silver market, when you look at a simple returning to 50 to 1, even if you went to 70 to 1, where it was just a couple of years ago, that puts silver at basically $60 an ounce. That's a solid, 50% gain almost. So you're talking about, I think, the value of a generation. And it seems that things are changing. The way that the market is moving. We're not seeing these massive sell-offs. We're seeing consolidation, choppiness, volatility, but the strength is something that is very different than what we've witnessed before. I'm very, very, very hopeful for what the rest of the year brings for the price of silver. I find it interesting that the LBMA came out the other day and warned of counterfeited metal, which they said distorts prices by creating artificial supply. And you think about that for a second and think this is the institution that's trading billions in unallocated bullion contracts unbacked, selling claims on gold and silver you can't deliver. Doesn't that kind of sound like you're creating artificial supply, counterfeiting in a digital form? I don't know. I'm just throw that out there. I laughed when I read that. But again, UBS is saying 38 to 42 through September 2025. They're talking just in a month through June 2026. So they're basically saying we're right there. By the way, for the people who we're recording this on Monday, the options expire today. So I expect today to be volatile, just like Friday was and Thursday. But I expect it to shoot right back up tomorrow. We'll see if I'm right when the next contract hits the board. You have to wonder, is it a conspiracy or is it reality when you talk about when Chris Powell says there are no free markets, just manipulations? The traders suck in the speculators, and then right at the end, they smash the price so that the options expire worthless. The big banks get to keep the premium on that, and then it goes right back up. They rinse, wash, and repeat. But this is a game that's much more difficult to do so. And it kind of reeks like we're getting to the end of this game. We've heard that before, but the level of the spread in the exchange for physical jumping up 250% last week, the no shares available to borrow of SLV, none when there's usually millions. The 7 or 8% lease rate, highest I've ever seen, the T+8 weeks, the deliveries. Things are changing, and it's as dumb as a mud wall to continue this game. I think they know that. I also want to talk about perception. You know, I wrote down homes are getting cheaper in gold. Now, homes aren't getting cheaper, but they are in gold. And, you know, people talk about this real estate deal where homes are so unaffordable. They're not unaffordable in gold if you've been holding gold, because measured in dollars, you're getting crushed. Measured in gold, you're winning. Since 2005, it's fallen off a chart. It's gone straight down. The amount of gold that you need to buy a home, it's at almost all-time lows or very darn close to it. So in other words, gold is keeping pace. The dollar is not. This is the point that needs to be understood, is that gold is not here to make you wealthy. It is wealth that keeps pace with inflation. Right. So if the average price of a house is like $400,000, you're talking, what, 130 ounces of gold buys a house for you right now. So, you know, what would it have been if you look? I don't have the graph on my computer here. I wish I did. It didn't transfer for some reason. I thought I had it on there, but it's a falling just like this, where in gold ounces, if you would have bought gold and put the money instead of in the bank, because you're going to buy a house in 5 years, and you put it in gold, it's gotten cheaper and cheaper and cheaper and cheaper every single year. Even with house affordability going stratospheric, no one can afford a house any longer, it seems, with the cost of money and the increase in the price of houses.
Schectman points to a compelling inverse relationship between fiat currency purchasing power and gold's consistent performance. Unlike equities or bonds, which are priced nominally and thus can mask real losses when adjusted for inflation, gold has quietly outperformed. While the stock market appears strong on paper, its value measured in ounces of gold has been steadily declining for over 2 decades. A silent bear market obscured by dollar-denominated reporting. This mirrors the fundamental principle that gold is not an investment per se, but a store of value that preserves purchasing power across time. This principle becomes even more pronounced when applied to real estate. While housing prices have soared to unaffordable levels in dollar terms, the number of gold ounces required to purchase a home has plummeted. Since 2005, the gold-to-housing ratio has been on a steady downward trend, signaling that gold holders have retained, and in many cases grown, their real wealth even in the face of rising nominal home prices. The same cannot be said for those storing capital in fiat. Schectman emphasizes that this disparity is no accident. It is the direct result of a monetary system designed to inflate debt away. When fiat loses value by design, the only viable hedge is to store value in something that central banks can't print. Gold fits that role perfectly, and increasingly, silver is being viewed as the asymmetric opportunity, undervalued, underrepresented, and now suffering from visible dislocations in its physical market. These dislocations include rising lease rates, delays in London bullion settlement windows from T+1 to T+8 weeks, and increasing delivery demands. Combined with rising premiums, unavailability of SLV shares to short, and tighter COMEX inventories, the signals point to a financial instrument approaching a stress point. According to Schectman, these are not random anomalies. They are indicative of a system where suppression is reaching its functional limit. Let's get back to Schectman's interview.
This is my thesis right now. I believe they are going to intentionally destroy the dollar. They're going to destroy the dollar to support the system. I think what they're doing with the stablecoin legislation is they are trying to move the majority of debt issuance to the short end of the curve through stablecoin issue, because you are seeing the governments that used to support our debt are no longer doing so, right? You have now the Cayman Islands and the United Kingdom and Ireland. It's a joke. And they understand that the amount of debt, we have to come up with $28 trillion in debt in 3 years when we only take in $15 trillion in tax revenue. We're not there. They understand that. And we're seeing less and less and less buying of our treasuries. So instead, they passed the stablecoin law where all of these stablecoins will be backed by US dollars in order to have demand for a treasury market that is losing demand. So you put that all on the short end of the curve, right? Where I think they're going to do it, and kind of blur the significance of the long end, which I'll get to in a moment. But I think that's first and foremost what they're trying to do. Remember when Janet Yellen did that? That was good for gold. That was good for stocks. It was inflationary. And I think that's what they're going to try to do. At the same time, they reshore all the gold and they're going to let it go higher and higher and higher and higher. Not very easy for the public to discern. There'll be volatility, there'll be consolidation, but it will keep going higher until people feel it's gotten too high. And then they'll probably come in and revalue it to a level much higher. And they're going to peg it to the treasury. Why would they do that? Why would they peg gold to the back end of the treasury market? The short end, the front end, will be backed by these stable coins, which they will pump out by the gazillions, because now they have this synthetic demand, not a organic demand like we used to have when we were revered and we ran a surplus and we didn't instigate wars all over the world and fund wars all over the world, and we're not revered anymore. So the back end of the market, who the hell wants, and especially when Trump talks about creating all of this money to rebuild our infrastructure. So in essence, printing money to build our infrastructure to compete with the rest of the world. They don't want to buy our treasuries. So they will just do the stable coins to get all of this demand for the front end and load the debt there. But the back end, I believe they will peg to gold. As Judy Shelton has said, on July 4th, next year, the 250th anniversary, he has said it repeatedly. Again, she keeps saying it on Twitter. He will peg the 50-year treasury to gold. Why would you do that? And you have to get gold much higher. And I think she keeps talking about gold revaluation. They will revalue gold. And I think Luke Groman, one of the smartest dudes I've ever met, he's talking about revaluing gold. He thinks they'll let it go to $7,000, $8,000, $10,000 and then revalue it to a much higher level to give the Treasury General account $5, $6 trillion in free, clear revenue without selling an ounce of gold. And we talked about how that happens. There's miscommunication on that too, because some people think that when the Treasury issues treasury certificate or gold certificates, gives them to the Fed creates the money, takes the gold, and gives the treasury money free and clear. Every $4,000 increase is $1 trillion free and clear to the TGA account. The Fed doesn't have control of that gold. They have control of the fiat. They're owed the money value of that gold, not the gold itself. Anyways, if they do that and peg it to the long end of the bond market, she said 50 years first, shorter durations, maybe 30 and 20, later, maybe 10. But why would you do that? Because now you can have zero borrowing costs. You can put a zero coupon on that. The gold redemption at the end is the borrowing, is the interest rate, is the inflation gauge. The more foolish we are in monetary policy, the higher the price of gold goes. To be able to get that at redemption would allow for long end low borrowing costs, almost down to nothing, which would then enable us to slowly reshore our manufacturing at very low borrowing costs, and then to grow our way out of this problem eventually. The only way you get rid of inflation and where we are right now is to produce our way out of it. And we're a long ways away from that, because in order to facilitate the amount of debt that we owe, pay it off, just the $28 trillion in maturing treasury debt by 2028 with $15 trillion in revenue, we're halfway there. And that doesn't take into account the $3 trillion a year in deficit spending. So you're 25% of the way there. So you have to inflate. They're going to destroy the dollar. They're going to inflate the crap out of it. They're going to use the stablecoin legislation to front load debt issuance into the front end of the market, and then they will let gold go to the heavens. I believe this. Truly, I do. And they will peg it to the long end of the bond market to have zero borrowing costs, to reshore manufacturing, to sell treasury debt, bonds at a much longer duration at a zero borrowing costs, redeemable in gold. I think they're going to do this. I truly do. And I guess we'll see. But I think to save in dollars now is the dumbest thing you can possibly do. You're destined to go broke. They're going to destroy the value of the dollar. They are going to inflate the crap out of it. There is no other way, period. So that is my thesis right now. And I'm very, very convinced that this is something that they are, if not implementing right now, it is, by all of the things that we hear and see. It'd be too long for me to go through the whole litany of them, but
returning to the core of Schectman's thesis, the use of stablecoin legislation to absorb short-end treasury demand is just one half of the strategy. The other, more explosive half, lies in the revaluation of gold, a move that would fundamentally reset the U.S. monetary system. Schectman highlights a critical reality. With over $28 trillion in maturing debt due by 2028 and annual tax revenues of only $15 trillion, the U.S. cannot finance itself under the current structure. Adding in annual deficits of $3 trillion, the Treasury is left with no alternative but to monetize. But doing so through traditional bond issuance is no longer viable. Foreign buyers are walking away, and domestic markets are saturated. The only path forward is to collateralize the system with something real: gold. Schectman takes this logic further than most analysts are willing to go. He suggests that a revaluation of gold, not to $5,000 or $10,000 per ounce, but as high as $150,000 per ounce, may be required to rebalance the books. This figure is not arbitrary. At a $150,000 gold price, the U.S. Treasury could backstop its outstanding debt obligations with a fraction of the gold it holds officially, creating what would amount to trillions in unencumbered credit for the Treasury General Account, TGA, without selling an ounce of physical metal. Every $4,000 increment in the gold price translates to approximately $1 trillion in clear revenue via gold certificate mechanisms. At $150,000, the windfall becomes transformational. This would allow the Treasury to issue zero-coupon long-term bonds, redeemable in gold, effectively creating a debt instrument that pegs interest rates to gold's performance rather than inflation expectations. As Judy Shelton has hinted, such a move could come as early as July 4, 2026, the U.S. semi-quincentennial. In such a structure, gold would no longer be just a hedge or a commodity. It would become the benchmark against which real money and credit are measured, and make it possible to finance a new era of industrial and infrastructure expansion, all without issuing a single additional dollar of unbacked fiat. But this outcome would obliterate the purchasing power of the dollar. Inflation would be sustained, aggressive, and intentional. Fiat savings would be decimated, bonds would lose relevance as real stores of value, and equities, while potentially benefiting in nominal terms, would continue to deteriorate when measured in gold. The smart money understands this. That's why we see massive central bank gold accumulation, continued suppression of physical supply, and relentless premiums on sovereign-minted bullion. The silver market is sending the same signals, with suppressed paper prices diverging sharply from physical demand, shrinking inventories, and tightening delivery mechanisms. These are not the signs of a healthy market. They are the stress fractures of a failing monetary paradigm. For those seeking clarity in a world of distortion, now is the time to pay attention. Subscribe to this channel, share this video with fellow investors, and join the conversation in the comments. Precious metals are not just an investment. In the age of engineered currency destruction, they are a lifeline. Thanks for watching, and see you in the next one.